We are live. Top 6 stocks for massive 2022 gains. Our high risk portfolio is now up 38% total return year to date. We just came off one of our best months in the history of our service in July. Here's how we recommend you invest $10,000 today with 6 easy picks. Per $10,000 being invested, this is the ratio of shares we're currently recommending. As you can see in the table format, we have a defense section and an offense section. The defense is deflation and offense is inflation. Step 1, buy 66 shares of the ETF UVXY. This is a leveraged play on the VIX. If the S&P 500 falls, the VIX goes up. This is currently about 7% of the portfolio at 66 shares per $10,000 invested. Step 2, we're betting big on bonds. With 142 shares of TMF, this ETF gives you 3 times leverage the 20-year US government bond. We're betting that interest rates are going to fall for the next 2 to 4 years and that TMF will break to new highs. Wait till you see the chart on TMF so you get excited for the potential profit with the long-term buy and hold in US Treasuries. And this is after a 2-year bear market that we've been slowly getting very aggressive in this bond play. Now, lining up with the bet that interest rates will fall over time, we have 2 really hot picks for you. These are tech stocks. One is ETHE. It's a grayscale trust that's been loading up on a cryptocurrency called Ethereum. This allows you to have exposure to Ethereum with the protection of a normal stock brokerage account. So you're not at risk at getting hacked. We're recommending you pick up 209 shares of the grayscale trust, ETHE. And this is, again, our single largest position in the entire portfolio. Now, what is Ethereum? I think of it as a ripoff of the US financial, insurance, and lending platforms, plus a ripoff of Microsoft Office, Windows, and all the software applications being designed on Windows, such as Microsoft Office, Excel. The list just goes on and on. The potential for Ethereum is massive, and it's a very new technology that's very early in its growth stage. Next up, we're going to pick up 100 shares of FNGU. This is 12 hot tech giants that have been around for several decades. They have already had massive growth. They're outgrowing every big company in the world and are likely to continue doing so. So you get 3 times leverage. And then again, this is a 100 share position coming in at 10% of the total portfolio. Finally, we got to hedge against bad energy policy in the US and even worse in Europe with the war marching on. This is artificially creating very expensive oil and natural gas prices. In fact, natural gas prices in Europe relative to the US are something around 10 times. So there's this huge arbitrage play shipping natural gas from America over to Europe as long as this war is going to continue marching on. So first step is buy 4 shares of NRGU. These are the big US oil companies that are racking up massive record-breaking profits. As long as oil is above 90, you want to be exposed to these big US oil and gas companies with leverage, ticker NRGU. Finally, the arbitrage play is very simple. Just look at European natural gas prices compared to American, and you can see there's this huge, massive price gap. We're long oil. Most likely that'll be the first play we take profits on. Germans are taking showers in the dark with cold water as they're trying to reduce energy use and fire up coal plants from a decade of bad energy policies. So that's our current trade alert. Most likely we'll be closing out Boyle first, NRGU second, and then rotating that capital into a mixture of UVXY, TMF, ETHE, and FNGU. The second we think this war is coming to a close. And I'll have more commentary on the war once we get to that section of the trade alert. Let's walk through the trade alert step by step. Step 1, pick up 66 shares of UVXY, your crash insurance hedge. What you need to know is in a severe decline where there's massive panic and limit down days in the stock market that can have devastating results to your retirement portfolio, you want to own UVXY and about 10%. Now, we were predicting a Fed pivot last week, and that's why we made so much money for our clients over the last week. So UVXY went down, and we were not loading up on that because we're quite certain the Fed would have to pivot due to a inverted yield curve. But if we go back to March of 2020, the last time we had a black swan event and a world lockdown event, this is the chart of UVXY going up over 1,000%. So if you had 10% of your portfolio long, your stocks went down 25%, but the 10% in your hedge doubled your entire account. So if you make 1,000% return on a 10% position, you get 100% total return. So it's a beautiful hedge. It rarely pays off, and that's why we call it our crash insurance. It acts like insurance. Now, some reasons to be worried about further declines is primarily the inflation. If the inflation doesn't start to slow down here, the Fed will have to rack up the hawkish talk once again, but they're very unlikely to do this until after midterms. It looks like Powell and Janet Yellen are going to be happy with 5% inflation, and the Democrats are going to shove through a new spending bill. So for now, it looks like the Fed wants to ignore the inflation, let it run hot through midterms. But there's some reasons to be concerned that the inflation could be stickier. Also, the longer that war goes on in Europe and bad energy policies are passed here in the US, the longer this could go on. But the dollar, DXY, getting to these levels has led to many crises in the past. So we'll see if it can be averted or if it's going to continue to be a problem. This chart shows you a lot of the Fed hiking cycles in the past have led to crises. Now, what it doesn't show you is how many times they've pivoted and saved the market from crashing. And that's what we are in the middle of right now. So we may be back to an inflationary problem after the midterms, when most likely the puck will have been switched over to the Republicans. We'll see how that plays out. But there's been two really bad periods of time in stocks in the last 100 years. One was very deflationary, leading to the Great Depression, which was 25-year period. And then we had the Nixon-Carter era of inflation, which was the exact opposite problem. Now, I'm not anticipating either of those in the coming years. Otherwise, we'd be getting far more defensively positioned. Step 2, buy 142 shares of TMF, the deflation hedge. We're betting interest rates are going to fall. Here's a picture of the TLT. TMF is 3 times the TLT's return. You can see the TLT just about goes up every year, and this is the way the government's able to grow debt. Unless we think the government wants to unwind its debt and start running an account surplus, you really don't want to be bearish on bonds for a very long period of time. We were lucky to be extremely long the TLT heading into the lockdown, and we got out with one of the biggest profits in our track record. And then we knew that if all this money printing was going to come in, it would be very bearish for the bond market. And so only recently we have become a very bullish bond player in our portfolio, and we'll continue to do so. I do see the TLT going back to that 160 to 180 level in this cycle, and that it should take about 2 to 4 years. Here's a shorter look at the TLT in a 1-month chart, bottoming out. It went as low as 108. But in this chart, you can see it hit 113 and then went up to 119.65. So interest rates are falling as the stimulus has slowed down and the entire global economy is slowing down. This is due to the inflation slowing down everything with the more expensive interest rates. In this chart, we're looking at LQD, the investment grade bond. We're not in this particular product, but it's critical for stocks that this goes up because this is how they finance their share buybacks. If you look at Apple, they're doing 4 new bond sales to do what? Dividends and share buybacks right now. That's one of the main reasons it's one of the best performing stocks in the entire NASDAQ index this year. A riskier bond product is the junk bonds with HYG. We can see it's also recovering. This is going to be also critical for other indexes like the Russell 2000. Again, we're not playing this. We're just making sure these are recovering to be bullish in our core positions. So here's a chart of TMF, and you can see it's up 10% in the last month, and it's just getting started. This is going to likely break to new highs. Now, if we break down the yield curve into shorter duration tickers, this is what's going to be dictating what the Federal Reserve is doing. So they're going to be very interested in what the bond market's pricing on the 3-month and the 2-year and how it compares to longer duration bonds. And long story short, the long end is starting to fall much quicker than the short end. So this is going to be very important for the Fed to slow down its hawkish talk, or it's going to have a very inverted yield curve. So here's your 3-month over a 30-year span, and you can see it's got a very downward trajectory of lower and lower interest rates. This jump up to 2.38 is the fastest we've ever seen in history, and why we had so much volatility this year. But what's been happening over the last month? It's stopped going up. So the market's finally getting happy with the Fed that they're going to slow down this inflation. What about the 2-year? Same chart. You can see it went up extremely quickly, but it's also now falling. In fact, it's even down over the past month. So it does look like the bond market is finally happy with the Federal Reserve taming down the inflation. Here's your 10-year chart. You can see, again, it's gone from interest rates as high as 15% in the 80s, and now we're sitting on 2.5%. And again, the only way the government grows its debt from here is to drive these rates lower and lower. Here's the chart on the 10-year, and you can see it's down 14%. Now, again, if interest rates are falling, the value of your bond's going up. So we can see the long end is already pricing in the rate cuts for 2023 and predicting the Fed's going to have to pivot here, most likely in September. Here's your 30-year, and again, same chart, same pattern, and a similar return in terms of interest rates falling on the long end. What about in Europe and Japan? These markets have been under extreme pressure. And so we're seeing the similar pattern. The Japanese 30-year bond finally stopped getting pushed higher at 1.2%. It's down from 1.3 in June. The German bonds, same thing. Now, again, they've had extreme inflation because they are very reliant on energy from Russia. And now that's been sanctioned. So they're paying extreme prices for energy now, and they just were not prepared for this. But even the German bond is now falling, predicting a recession. Italy's bond, which has been paid for with the rollover of German debt, same thing. And this is what the ECB was saying they would do, is protect these various government bonds from rising too quickly as they jack up interest rates. So Europe's actually in a position where they're going to raise interest rates and do quantitative easing at the same time. Almost hysterical. Here's the dollar index. Again, as interest rates were rising, the dollar was going up, and also energy prices were rising, specifically oil and natural gas. Now that's all starting to cool off, and we're finally getting the DXY to cool off as well. If we look at the longer term chart on DXY, we can get these spikes in the dollar, but they're usually followed up by an extreme decline in these in the dollar index against primarily the euro and the yen. So we're looking actually for a 4-year period of the DXY falling. I think it'll bottom out somewhere between 80 and 90. And that's going to be a time to take massive profits off our cryptocurrency and bond positions and really bet on a reversal in markets. Here's a look at the euro versus the dollar. And again, this is the first time you're getting a dollar to dollar on the euro in decades. We're also seeing the cool off in the Japanese yen. It was devaluing all year, and finally we're starting to get that reversal as well. And that's because we're starting to get Europe to tighten a little bit as the US is starting to pivot dovishly. And now, again, they're talking about passing some more stimulus. Same thing with the Chinese yuan. It was devaluing, and now it's flatlined. So everything is really starting to revert. Another reason to be long bonds is in this chart, a lot of people are saying the payrolls are so strong, there's no way we could be heading into a recession or even in one currently. But this chart shows you that the payrolls do slow down and then convert to negative payrolls towards the end of the recession. And the best time to buy stocks is not necessarily at the end of the recession, but somewhere in the middle. And I think we are at that perfect time to be long stocks, so long as the inflation is going to slow down here. And we have every reason to believe it will. Here's a look at the median house prices falling quite precipitously. Merchandise at retailers is at extreme levels, so they're going to have to start discounting inventory. We've got lumber futures down over 50% since March. We've got copper futures falling off a cliff. Now it has started to stabilize, which is good news. We don't want to see copper completely crash because then we'd be worried about too much deflation. And then again, this is because China is starting to boot up their economy. The Baltic Dry Index, which measures the cost to ship commodities between continents, has crashed from 5,000 to 2,000, still at a high level compared to historic prices, but dramatically lower than when we were having these really bad inflation prints. Wheat futures, despite the sanctions in Europe on Russia and Ukraine, are down significantly from 1,200 down to 800. So I do believe we will start to see the CPI turnover and fall for the remainder of the year. And just about the only thing that changed my mind is if they somehow piss off China and India, who are buying the Russian oil, and jack up oil back to above 130. That would probably be one of the few things I would see to get the inflation rising from here. Here's a look at that inflation that caused the bond market to fall off a cliff, going from 3.5% all the way up to 6% on the core. And again, it did fall month over month. Here's Chicago PMIs heading to negative territory if they go below 50. The Michigan consumer sentiment is at the lowest we've seen since the 80s. Again, that's usually a great time to buy stocks. Everybody thinks the inflation is going to get worse and worse and worse, and it'll never improve. And the reality is peak inflation's almost certainly behind us. Starting to see a pickup in initial claims. So Friday we'll have non-farm payrolls come out and more initial claims data. So I think we're going to continue to see the labor market start to slowly cool off as we continue to recover the economy here. The 10-year over 2-year spread has inverted, so we're dealing with an inverted yield curve that almost always forces the Fed to pivot. And sure enough, that's what the market's pricing in with the latest Powell speech on Wednesday. Now, to be clear, he really just said he's going to stop giving forward guidance and be data dependent. So we really do need this inflation to cool off. Okay, so here's some other charts on the inflation. Here's your core inflation. It fell from 6 to 5.9 in the previous month. We've got PMIs globally going negative from Germany, Italy, Austria, Poland. The car index, used car index, has turned negative. This was driving the CPI for quite some time, along with RVs of all things. Container shipping rates have been falling precipitously as well for several months, and the bond market's no longer believing the Fed by having these future prices actually pricing in rate cuts into 2023. Soybeans down dramatically, wheat down dramatically, corn down dramatically. The entire spectrum of bonds down dramatically for several months now. So the whole economy is cooling off. Great time to be long tech and bonds. And again, our last inflation hedge is NRGU and oil. Second that war ends, we want to get out of the way and dump those shares. Step 3, buy 209 shares of ETHE, the ultimate growth product. Here's a look at Ethereum over the last 1 month, up 58%. Finally, if we look at a longer term chart, Ethereum is up 11,000% since 2017. One of the fastest growing assets in history. I think over the next decade or two has the potential to have a larger market cap than Bitcoin. Here's ETHE, Grayscale Trust, actually up 70% in the past month. That's because it had fallen more than the actual asset. So it was actually trading at a great discount. Much of that discount has been erased in this recent melt up on ETHE. This chart shows us the supply held by addresses with less than 1,000. So small investors have been loading up on Ethereum in this sell-off, hitting a new record level. This chart's looking at the 200-week moving average for Bitcoin, showing it's only gone below its 200-week moving average 4 times in history. It did double bounce in 2015 off of that, but what happened shortly after was one of the biggest melt-ups in Bitcoin in history from 2016 to 2018. RSI readings were off the chart to get aggressive, and so this is all pulled off quite well. after having the worst month ever, losing 40%. So buy the dip. There's lots of blood on the street. Next stop with this cycle theory is 300,000 for Bitcoin. And I do think that's quite possible. And I'm expecting the top to be in about 2 to 4 years based on the bond market. Also, we just had the worst quarter in history for Bitcoin of a negative 56% in Q2. Now, why we like cryptocurrencies? In general, it's because we believe governments will continue to print money via issuance of debt. And this shows you just how bad it is. It took 215 years to reach 7 trillion in US debt, and then it only took another 2 years to print an additional 7 trillion. Now we're running at $1 trillion a year deficit. It's just going to grow consistently from here. There's no way out of it. Step 4, buy 100 shares of FNGU. This is 3 times some major tech giants that have massive amounts of call options. Now, this is not an early growth stage ETF like Ethereum is. So we're not expecting near the return, but these companies all have extreme monopolies in their respective marketplaces and have been one of the safest places to grow capital over the last several decades. Now, this shows you just how strong some of these companies are, like Amazon, hitting a new record for Prime Day retail sales just several weeks ago. This chart's looking at consecutive days with NASDAQ new lows, and we're at 2008 levels. So this is a great time statistically to be getting aggressive in tech. Here's FNGU over the last month, up 36%. And again, it's leverage times 3. So it is getting a similar performance as ETHE. Now, over the past year, this ETF's down 71%. Here's a look at the S&P 500. Now only down 11.5% on the year, so starting to rebound. Here's the NASDAQ, only down 16% on the year after a very aggressive rebound over the last month and a half. Here's emerging markets. In our safe growth strategy, we have exposure to emerging markets. Likely not going to get the big bid on EEM till DXY falls and this crisis in Europe is resolved. And I do think we're getting near that point in time. We'll talk about that once we pull up the oil and natural gas slides. But the time to get more aggressive on EEM is very, very soon, in my opinion. We're keeping a close eye on European markets to make sure this doesn't take down the entire global economy. And they've also had a similar return as the NASDAQ this year, despite being the center point of all the energy problems. In our safe growth strategy, we also have a uranium play. This is going to be a key to clean energy over the next several decades, down 12% with a nice rebound over the last month. We're long lithium with rare earth metals to power everything that uses a battery. Down 15% year over year, year to date, but with a nice jump over the week as well. Some individual stocks having some huge gains. Amazon up something like 25% in July, only down 15% on the year. Apple outperforming the NASDAQ dramatically, only down 5%, gearing up for some massive stock buybacks by issuing debt. Alibaba had a headline that the SEC is threatening to delist it. I believe this is all just war talk due to Pelosi's trip to Taiwan. So we'll see how this all plays out. But man, this thing has been jumping up and down between 90 and 120. This is a stock we have in FNGU that gives us good exposure to Asia. Now, tech stocks are not irrationally priced compared to some of the bubbles we've seen in the past. These tech stocks print money like no one's business. In this chart, we're looking at the 12-month return of picking the perfect bottom in a recession. And it's really important to note that the market trough is never at the very end of the recession. The average 12-month return is 43%. So we believe now is a very good time to get aggressive in these plays. So this is the forward multiples on the S&P 500. We're at the yellow line. We certainly could hit the blue line if the inflation's much worse than we think and profit margins get compressed and the consumer dramatically slows down its purchasing. At this point, I'm not seeing that as the base case. Insiders are buying the NASDAQ at record pace. We haven't seen this level of buying since 2012, typically a good signal to go long tech. Here's the farm payrolls. As long as this is not coming in red hot above 500,000, we're very likely in a Goldilocks situation with nice steady growth on the labor front without it overheating the economy. So we'll keep a lookout. Friday, we get a new non-farm payroll. I'll update you on that on Monday. Bank credit continues to grow substantially. So the bank credit looks very healthy. Consumer credit keeps growing, no slowdown or big panic in consumer credit growth. And U.S. retail sales, while slowing down, are still at magnificent levels that we've never seen in American history. So the consumer is still very, very strong. U.S. balance of trade still coming at extreme negative levels, but slowing down a little bit. This is good for our bet that the dollar will weaken over time. Chinese imports, after crashing in February due to a countrywide lockdown, are popping back up, showing that China is still alive and is going to keep the global economy trucking along. Chinese PMI back above 50, showing growth after going almost to 35 in April, again from a lockdown that was self-imposed. And now we have Chinese exports back up to very high levels, printing 308 billion, with the record being 340 billion last December. So still at very high levels, showing China is still alive and keeping the global economy running. Step 5, buy 4 shares of NRGU, the inflation war hedge. Now, we did have a pullback in the price of oil to get it just below 100 again. This is because we've reversed some of the sanctions on Russia, specifically regarding insuring boats carrying Russian oil. Now, this map is potentially what Russia's aim for is in terms of the new Ukraine. So you can see it's going to be potentially just Kiev. We'll see how this plays out and just how far Russia wants to push this narrative. If you follow Peter Zahan, he believes Russia will continue this war for perhaps the next decade or two, and eventually wants to take over a whole bunch of countries, including Estonia, Latvia, Lithuania, Belarus, Ukraine, and Moldova. So I expect a short-term pause in the war, most likely by September, assuming the Ukrainian offensive on the south side of the war near the Black Sea is unsuccessful. Now, if it's successful, this thing could escalate and get much worse into winter. So we'll see how that plays out. Meanwhile, keep in mind, we've been dumping the strategic oil reserve to keep oil from going up. So even with a massive dump of our strategic oil, oil's still at 100. So very bullish on oil until the war ends. Here's another look at that in terms of entire U.S. petroleum inventories, including the strategic petroleum reserve. Very low levels, very dangerous if we were to enter a serious war. Okay, here's the chart of NRGU. If you know, we made a huge profit on this earlier last year and sold it early this year. Then we rotated into Boyle, made a huge profit, and then we've been back into NRGU and Boyle. Boyle's outran NRGU so far, but both are very good prospects to hedge against inflation and the risk of the war escalating. Now, as you can see, the price of oil peaked out when the war initially hit and has been slowly drifting lower, following all the other metals and commodities which have crashed over 50%. So I do see oil probably maybe overshooting to the downside to 70 and then bouncing around 70 to 90 as soon as the war ends, just due to the long-term demand for energy compared to the supply side that's available probably in our lifetime, especially with the local policies. So that's what we're looking at. We got to be careful with this play. It looks like almost certainly the war will march into September, and then there's a high likelihood that we could see a truce at that point. I do think August will be a big offensive move by Ukraine on the south side near the Black Sea, and that we're going to see Russia try to sack Donbass, and then we'll see how the war shapes up from there. Here's one of the big companies in NRGU. Exxon. And again, if oil is going to be above 90, we want to have exposure to these U.S. oil companies that have a monopoly here on the U.S. Production of oil. Here's that chart. And again, down towards the bottom of the screen is where Ukraine's getting ready for its big offensive push. And it does look like they have amassed quite an army there. They're trying to bomb some bridges that the Russians use to refill their troops there. Meanwhile, up above that area is where the Russians are very close to sacking Donbass. So we'll see how this all plays out. At this point, I would expect Russia is going to have success on both wars, and that we could potentially see some sort of ceasefire in September. Now, again, the reason why oil is starting to slow down in the price rise despite the war marching on is because China and India are buying all the oil and then reselling it to Europe. So it's comical, and why we're starting to see these political people reverse all these sanctions, because they're clearly not working unless you want to raise the stakes by sanctioning China and India, which I don't believe is going to happen ahead of the midterms. This is just looking at some technical analysis of commodities to buy the dip. And other reasons to be long energy is that we do still have a very strong economy. So we can see job openings are at record highs relative to the labor force and continue to grow. So we are starting to see some more people file for unemployment, but we're still seeing a healthy amount of people get a new job every month. And again, as long as it's between 250 to 500,000 jobs added per month, I don't think it's going to piss off the bond market at this point in time. Step 6, buy 25 shares of Boyle. Here's your price of US gas futures compared to European. And you can see we're at 25 and they're at 175. So almost 10 times the price. So there's this huge arbitrage to get natural gas from America to Europe. And that's one massive profit center for the US during this war. Here's Boyle. So we sold it on the first run up, got out, and we bought the dip, and we're up big. This will be most likely the first position we want to sell because we're already back to very high natural gas prices. Now, the Europeans are trying to make commitments to reduce consumption by 15%. They're putting limits on temperatures in apartment buildings. They're taking showers in the dark with cold water, all sorts of nonsense. That's not going to be popular with voters for long. So the problem is Ukraine's about to make a huge offense into, again, the south near the Black Sea. If it's successful, look for Russia to ramp up all sorts of rhetoric and most likely completely cut off natural gas to Europe if they start to lose. So we'll see how this plays out here. But the big offensive is probably going to start happening in the coming weeks. Now, this is looking at the European gas storage, and there's just not enough storage with Russia cutting off 80% of the gas to Europe currently. They have no chance in getting to good stock levels. So if there's not a resolution in the war, Europe's going to have huge problems this winter with energy. Another look at the German electricity going from $50 to $300 due to, again, these sanctions. Now they are ramping up their coal after decades of clean energy policy, and now we've got people all over Europe, Canada, starting to cut off nitrogen to farmers, essentially putting them out of business. And now we have farmers revolting. So this is slowly falling apart for the so-called globalists. Jeffrey Gunlick says, "Dear Mr. President, please admit excessive stimulus and lockdowns were significant drivers of inflation and pledge you will not support either of those policies again." So we've avoided the lockdowns. It looks like they are trying to push some more spending through. So the war has been a good way to sneak money through the government. And now they're looking at a new anti-inflation bill, so we'll see if that gets pushed through. But it's looking at about $1 trillion of stimulus. We'll see if that gets pushed through or not. Okay, very good. So this is where the video ends. If you're not a paid member, make sure to call Dean to upgrade because we're about to overview our exact positions and where we see trade alerts coming. Call Dean now at 505-322-7515. Here's our little disclaimer. I'm gonna look for questions and then go into a breakdown of the trade alerts. Okay, great. No questions yet. As you know, I've stopped reading the news. That's to protect us from the censorship out there. Okay, one question is why are we long the oil and gas companies instead of the price of oil? Yeah, I don't think the price of oil is going up, so I'm not long USO. I believe we're going to stay in this range and that Exxon's going to make a ton of money. That's basically why. Okay, so let's look at the safe growth strategy. First of all, we had a huge return to close out the month, 13.7% return for July, and we're down 18% on the year. We're really set to make a lot of money in a stock rally for the remainder of the year. So I don't see a whole lot of changes. We're going to sell NRGU probably in the end of August or early September, assuming we're predicting the war is going to be completed. If we think it's going to ramp up and that they're going to actually try to really severely hurt Russia's exports of oil, then we're going to bet that NRGU is going to go up for a much longer period of time. So let's see how these Ukrainians fare on their offensive. It's going to be really the key. So yeah, that's the only trade I see. We'll most likely add to TMF and Bitcoin will be the two easy plays for the portfolio. Treasuries and maybe top up our UVXY. Let's see, host and panelists. So yeah, I read all the chats that come through. I'm not sure. I think you have an option to pick who it goes to. Yeah, you can click everyone in the drop down. The YouTube link does work. That's how you got to the webinar right now. Okay, so that's the plan for the safe growth on the high risk. Boyle's gone up a lot more than NRGU. If you remember, they both started off at 15.15, and because Boyle's gone up so much more, Boyle's now worth 21 compared to NRGU at 16. We've got plenty of treasuries. We're most likely going to add to FNGU, ETHE, and UVXY as we start to peel off Boyle. And if we think the Boyle's gone up too much and the war is going to keep going on, we could take profits out of Boyle and rotate it to NRGU. And again, we need to see how this war is going to shape out. And mainly, we need to see what happens with this offensive move. July came in at a really nice return of 32%. Bringing our total return to 38% year to date. So that's really what we're looking at. I guess the big hype today is Pelosi's going to go to Taiwan. China's talking about blowing up her planes and this and that. I see zero chance of this. And the reason why is because China can't feed itself, nor provide itself with energy. So the likelihood that they're going to start a war over Pelosi visiting Taiwan is completely unlikely. Okay, Elliot says, I see some sort of merger talk for Ethereum in September. Yeah, the merge, not merger, but merge. They're switching to proof of stake from proof of work. And then it's going to start burning Ethereum. So it's actually going to be more deflationary. Bitcoin has a limited supply. And we're going to run out of that in like 20 to 50 years or something very far out. And it becomes more and more expensive to mine the halving every several years. Ethereum is going to actually start to lose its supply. So more like a stock buyback. So yeah, Ethereum has some very, very bullish events coming ahead. Okay, so Steven says he doesn't have the email. I'll make sure you get the email resent to you, Steven, and check why it's not going. I'll send Ryan notes on that right now. How was the audio quality for everyone? Mike's saying his audio quality wasn't good. Okay, everybody says audio is good. Stephen, what email are you looking for to get your emails? Ryan's asking. Oh, he meant. Never mind. We know what your email is. Sorry, he meant which one, Rebel or PB. Okay, everybody says audio is great. Okay, good. PB. And I'm going to ask why you can't see post to everyone. Yeah, the news is just too risky. They are quite literally hunting down people with alternative views to the narrative. And my job is to make you money, so I'm going to still have the alternative view, but focus on the charts, the reasoning, and make sure we're just focused on making money here, rather than reading news that could get basically put us on some sort of list that gets attacked. It's just outrageous what's happening. I'd have to probably set up a whole new channel just to complain about the political attacks currently underway. I'm sure Stephen understands exactly what I'm talking about too on that end, or most of you guys do actually. But yeah, a few months, we finally made a huge gain. Everything we were expecting is coming into play. The inflation's slowing down, the Fed's pivoting. We're worried about midterms, and now they're passing some more spending. So quite well set up for the foreseeable future. Just carefully pull off Boyle, NRGU, rotate it, and then focus on the war, because that's really what's driving the last little bit of inflation. And so yeah. Yeah, and I do still tweet all the stuff on Twitter, so you can read my Twitter feed. Yeah, if you follow my Twitter feed, you can read all the news, and you can also see me lose my temper and post comments about stuff sometimes. But yeah, the Twitter feed is at, generates income with an S. I know we all miss that. But as far as protecting the business and making our investors money, that's why I've changed up the format to a bit to avoid commentary about politics, essentially. All right, beautiful guys. So we'll have Rebel dividends tomorrow. Now remember, if you want to get a more aggressive Ethereum position where we actually own all the applications being designed on Ethereum with leverage, with a weekly dividend, we have a private equity offering called Rebel Dividends. It's only available to paid clients legally. That's the only people we can take into it. And it's designed to replace your ETHE position or your GBT position. So you still want to follow the whole strategy, but just take that allocation and then I can manage it for you personally, and it's going to be much more diversified. So rather than just, a good analogy be rather than just owning Microsoft, you would own all these software applications being designed on it, which have far greater growth potential. So definitely call Dean if you want to learn more about that with Rebel Dividends at 505-322-7515. So we'll have Rebel Dividends webinar tomorrow, and then we'll have our next Portfolio Builder webinar on Monday of next week. I don't anticipate any trade alerts because this offensive move by Ukraine is going to likely take several weeks, and that's what's going to drive energy costs higher. And our next play is to dump the energy plays. Donald saying, so I would take my ETHE. Yeah, so you would sell those and then buy shares in Rebel Dividends, and that would replace your Ethereum position. And now you have me personally managing it with a much more aggressive play that's more diversified. So we're running about 135% leverage. So for every dollar that you have, it's going to have about $1.35 of exposure. And rather than just owning Ethereum, you're going to own a whole basket of cryptocurrencies. And they're just the most successful products that have been designed on the Ethereum operating system. So it'd be Uniswap, Polygon, Link, Sandbox, Mana, Aave, and Curve is our basket of cryptocurrencies. Yeah, exactly, Donald. So Donald says, so no ETHE. So whatever dollar amount you would normally have at ETHE, you could replace that with Rebel dividends. And it'd be the same type of exposure, just more advanced and managed by me personally. Plus it kicks out a weekly dividend. Okay, beautiful guys. So we'll have our live Rebel dividend webinar tomorrow, and then we'll be back to Portfolio Builder on Monday. Only big stuff coming out this week. We have the ECB rate hike expected to be 50 basis points, and then we're expecting the non-farm payroll to come in good, but not too good. And again, we don't want it too good with the way we're positioned. Okay, guys, have a great rest of your day, and we'll see you back tomorrow for Rebel and Portfolio Builder on Monday of next week. Thank you so much.